Hello, this is Monica Sawyer. Welcome to Real Estate Investing for Women, where we focus on all aspects of real estate investing, including strategies, mindset, emotional mastery, money smarts, and so much more to ensure your success. If you'd like to learn my personal favorite investing strategy, just go to blissfulinvestor.com. You can also listen to this episode on the Real Estate Investing for Women podcast on iTunes. Now, let's welcome our guest. Hello, ladies. Today, I'm so excited to have back at the show Maureen McCann. Last week, we chatted about sort of what's happening in the economy and what we can anticipate in the future. Again, it was not meant to be predictive, but kind of our view on how resilient the real estate market is and why we think people should continue to take action even now. So I wanted to continue that conversation because that one got pretty long. So I wanted to continue that conversation this time and really talk about the numbers. Like if you were to start investing in real estate now, what are the different ways that you could make money so that you can build wealth? And Maureen is the queen of helping people understand what a real estate portfolio can do for you. So she is exactly the right person to talk to us about this. But before we move on to that, Maureen, you had a few other articles you wanted to share that kind of talk about the big view on the market. Could you share that stuff with us first?
I am. I'm going to cheat though a little bit because I have my little printout here, but this is actually one from the Wall Street Journal. So, and this was published, do I have a date? June 1st. So this is not old. This is new relevant information. And the headline says, can you read it? Yep. So it says, Wall Street bets virus meltdown gives landlords a chance to grow.
Wow.
And so these are the largest home leasing companies have strong occupancy, rent collection, and expect demand for suburban houses to rise. So I want to just there's one thing I want to point out in this article right here.
And this is from the Wall Street Journal.
Wall Street Journal. So this is no, schlepper publication.
These are the big guys.
Big guys, right? So there is a company called Invitation is the name of the company. It's the country's biggest single family rental company. They have over 80,000 doors. They last week, so here's something interesting. This is again, June 1st, last week reported record occupancy of its roughly 80,000 houses and better than normal on-time rent payments in May, despite the pandemic leaving millions of Americans unemployed. Now this is true for my company. I don't have 80,000 doors. I have 1,200 doors. It's still growing. But there's other companies that I know. A good friend of mine, they own a company that has 6,000 doors under management. Same thing. Rent collection is high. So when you're looking for an investment and you're looking for something that's, not everything is bulletproof, but more safe and secure. During a pandemic, you've got 80,000 doors that the majority of the rent has been collected. And I said the same thing on the last segment. And I know that my good friends in this industry, same thing. But I want to read one more important little bullet point out of this, okay? So it says, American Homes for Rent, the second largest with 53,000 houses, said it isn't much below its own pre-pandemic levels of rent collection or occupancy. The company said and this is what I want you to pay attention to, right? What does this say? When I read this, I want you to think about what this says to you. The company said a $225 million venture to build rental houses that it struck with J.P. Morgan Asset Management in February was enlarged in recent weeks from $225 million to $650 million. J.P. Morgan Asset Management, they are putting a bigger bet on single family rental properties. Think about that. If J.P. Morgan Asset Management Group and leadership team is thinking that, why are you not thinking the same way?
Well, and this is a really, really interesting point because I can hear everybody saying, well, I'm not JP Morgan. I don't have millions of dollars. I don't, I can't spread my risk. I can't do all those things. Here's the really awesome thing about real estate in the United States, and we are so lucky here, luckier than any other part of the world. We, as the layman and the little guy, are supported in a million ways, maybe not a million, that's an exaggeration, but we're supported in so many ways to buy real estate and to get supported. And actually, that's what one of the things that Maureen's going to talk about now is even the little guy can do the multi-billion-dollar strategy. Think about that. Where else can you do that, right? You, the little guy, can do a multi-billionaire strategy. That's where they make the money, and that's where you can make the money. You just have to get started and get started with people that are going to help you get there.
And it's one property at a time.
That's right.
One property at a time. And
that's right.
We live, and you said something that was really cool, is that there are products there out to support us. I think we are the only country that has the 30-year
fixed
rate.
Mm-hmm.
So that means you can lock in to cheap money for a long period of time. And there is a lender, a banker that's willing to give it to you. Now, they're smart. Think about this. If you were a banker, you'd go, I'm going to create a 30-year or 40-year note because I'm going to collect interest on that for that period of time. Smart, super brilliant, right? We as the consumer of that product can say, yes, I want to utilize that. Thank you, Mr. Banker, for giving me the money. I'll happily pay you the interest. And as long as there's no prepayment penalty, I'm going to get that paid off as soon as I possibly can. So I have more cash flow coming to me later.
That's right.
Yeah.
Yeah. So there's the high level, but let's dig into rate of return. Yay! My favorite topic in the whole world. Well, actually, leverage is my favorite topic, and that's part of it. So,
yeah. I do this with, when I was talking to Monica about this, I was sharing with her, this was her idea, right? I was sharing with her some of the conversations that I have with my investors. And these are very highly educated professionals. And, sometimes you make the assumption that they know certain things, like how you calculate the rate of return. And I have learned just through experience that if you actually walk people through how to calculate the rate of return, what the formula is, and then you plug it into the 5 ways that real estate pays you, the light bulb in their mind illuminates and they go, oh my gosh, no one's ever showed this to me before.
And why am I not taking advantage of that yesterday? Right?
Yes. And so I thought, why not? And this was Monica. She's like, why don't you come on and let's just talk about rate of return, how you calculate it, because I get so much mileage out of that conversation with my investors on one-on-one. So we're going to do it here collectively. So as you're listening, you literally have to go get a piece of paper and a pen or a pencil. I don't care, but you need to write this down because we are going to go through the 5 ways that real estate pays you. And we're going to plug in these numbers into this formula. And it's not hard. It's really not hard. And it's so, once you get through it and you see how this works, then you'll recognize why Monica and I are all about women in real estate and how real estate builds wealth. And we want this for you. So get your pen, get your paper.
And so now what you're going to do is you're going to turn off this show for just a moment. You're going to push pause. You're going to run and get a paper and a pen. Go do it. Push pause. And then come back to us, okay? And turn us back on. Here we go.
Yes.
So welcome back.
All right. And okay, so the first thing I want you guys to do is title your blank piece of paper, the 5 ways that real estate pays me. Say you, because it's going to pay you. All right. 5 ways that real estate pays you.
Pays me. The 5 ways that real estate pays me. Me in caps, right?
With a dollar sign at the end of it.
In red. Oh, no, not red. Green. I don't know. Some color.
It's not red.
I like red because it's an active color, right?
I know. Yeah. I know. And I've read many stories about women in red dresses capture more attention
By
than
other,
any other color dress
that's
that
right.
you wear. Women and men both pay attention to a lady in red. I just don't look at it. Red on red, it is the worst contrast on me.
Maureen's a redhead, so yeah.
So my one friend, we were shopping and she saw this red dress and she grabbed it. She's like, "Oh my God, you would look great." I said, "I look horrible in red." She goes, "No, you don't." I took the red dress and I put it up to me. She goes, "Oh yeah, no, that's
No,
not color."
Yeah.
All right, ladies, are you ready? So the first thing I want you to do on the top of your paper is write ROR, rate of return. ROR equals profit divided by equity. When I first learned this, I'm going to give you a little backstory. My business partner, Clayton Mobley, he is a quantitative finance genius. He could tell you numbers back. He can run numbers in your head like Rain Man, but he's got a personality unlike Rain Man. And for you young millennials that have never heard of Rain Man, just know he was a really bright kind of like guy that couldn't really talk. He didn't have a great personality on the outside. Anyway.
Rain Man was.
Rain
Not
Man.
your partner. Yes.
Not my partner.
Yeah.
My partner is brilliant. He is so smart and younger than me. And I love him for all of that and hate him too at the same time. No, just kidding. I love him to pieces. And he taught me this because my background is exercise physiology. I picked my major because I wanted to avoid calculus. So I looked at the syllabus to find out which course didn't have calculus. And that's how I chose my major. I'm not kidding. That is exactly the truth. And so numbers are not my game. But when you put dollar signs in front of numbers, I get really interested. And that's what he did for me. And he showed me what the rate of return formula was. And he's like, "Maureen, rate of return is profit over equity." And I was still like, don't know what that means. And he goes, "It's easy. It's what you make divided by what you have in on the deal." Easy. I'm like, "Oh, what I make divided by what I have in. Perfect. I got this. Done." So if some of you are still struggling with that, here's what I did. And here's what helped me. I took a Post-it note and I wrote ROR equals profit divided by equity. And I put it on my PC. So I saw it every single day until it was etched into my mind. So do the same thing if that's what you need, okay? Now, here is what we're going to do. This is where it gets fun because now this is where you can see the cash and the earnings and the money come through a single family rental property. Are you ready? Let's do it.
I'm ready.
Okay, first way that real estate pays you is through appreciation, right? You own an asset, you hold on to it, you put a little bit of your money in, you borrow a lot of the bank's money, and then the property year over year consistently increases in value. You may have some down periods, but it comes back up. It's one of those things, it just goes like this. Long-term buy and hold, the value of the property is, if you hold the property for 10, 20, 30 years, you're going to capture some capital appreciation. It's just the way that it works. If you live in California, you know what I'm talking about. It can be crazy appreciation in 12 months. In other markets, it's more tempered, more moderate, but it's still earning money for you. You're earning that way. Now, across the United States, the average property increases in value 6%, okay? So let's take $100,000 rental property because I like simple math. I like easy numbers. The more complex it is, my mind goes mush, okay? So let's say today we buy a property for $100,000. 12 months from now, it appreciated 6%. That means your property is now valued at $106,000.
So write this down. You started with 100. 12 months later, you're at 106.
Okay. Monique, I'm going to ask you this question so you can answer it collectively for the listeners. Is that $6,000 profit to you? Is it profit?
It's $6,000. Yeah, it's $6,000 profit. It's a lot higher percentage than that, though.
There is in other markets, but I'm going just generally across the United States, right? Because I've got some markets, some zip codes in my markets in Birmingham and Huntsville that are appreciating 10 to 18%.
Well,
right?
But let me say what I mean by this, and you might be going into this in a minute, but so we're talking about, you got a loan, right? You put a little bit of your money in and you got a loan for the rest of it. So we're looking at a $100,000 home. You probably put $20,000 in.
Yes.
Right? Yep. The bank carried $80,000. The property went up $6,000. So did you make 6%? No. You
Yeah.
made $6,000 on $20,000. You didn't make
That's what we're
$6,000 on $100,000, right? So what
Yeah.
is that percentage? Actually, ladies, I'm going to calculate this for you really quickly. You made $6,000 on $20,000 that you invested. 6 divided by 20 is, you made 30% of your money that year. 30%.
Yes. So yes, and that was the most beautiful sort of conclusion and segue into how appreciation works, because if the market just say generally appreciated 6% in that year, your property went from 100 to 106. That 6,000 was profit. Remember the formula. Look back at your formula. Rate of return equals profit, 6,000 divided by your equity. And I always say use leverage. Some people are really debt averse, so I'm not going to probably convince you, the Dave Ramsey types. Awesome for the consumer debt, get yourself out of it. But there is good debt that produces cash flow. And that's the kind of debt that Monica and I are talking about. Use bank money, leverage into as many hard assets as you can that will produce cash flow for you. That's money into your account every single month versus money out of your account every single month. There's a difference between the asset and the liability. So with the first way that real estate pays you is through appreciation. And if you made $6,000 in 12 months and you divide that by your $20,000 down payment, your rate of return, again, profit divided by equity, computes to 30% rate of return on your money. Why is this important? Why is that number important? Here's why. Let's put things in perspective as we go through the other 4 ways that real estate pays you. In order to create wealth, you have to, your money, no matter what you put it in, I don't care if it's, I should say oil and gas. That may not be a good, whatever vehicle you put your money in. It could be cannabis, cacao, it could be agriculture, it could be oil and gas, it could be anything. It could be real estate, right? Gold, silver. The thing is, you are looking for a rate of return that is higher than the rate of inflation. Mm-hmm. That is how you get your money to grow faster than inflation can devalue your dollar. Do you get that? Mm-hmm. So 30% rate of return just on the appreciation piece of holding a single family door. Let me do something interesting here. What if we only made 15%? Let's say we go back to that same property that was 100,000, and let's say the capital appreciation over the next 12 months was only 3%. So your house went from 100,000 in value to 103,000 in value. So you would take your 3,000 divided by your 20,000, because your profit is 3, your down payment was, and your equity is 20. So 3,000 divided by 20,000 comes up to 15%. Are you okay with 15% knowing inflation? You know, this could be a part that could be challenged or argued. I don't believe what the government reports to me about the inflationary rate is. It's on the lower end for their benefit, so that they can extend out Social Security payments, because it's based off of the inflationary rate. It really is, in my opinion, it's around 6%.
And so the best way to notice that is, Maureen said this in another show. You're going to Whole Foods. How much can you fit in the basket today than you could 10 years ago? Mm-hmm. Right? Yeah. So just, we can actually see it in our lives that inflation is not 3%. You can't fit 3% less. You're fitting a lot less for the same dollars.
Correct. So your rate of return, again, whatever it is, it has to be greater than, for me, it's got to be 7% or higher, or I'm not going to do the deal ever. Okay. So
can I just interject one thing? Oh. Just so you know, like we talked about the accountant last time, right? That advised against. Your accountant is going to say, you just made 6% on your money. You can do that in the stock market. And it's a lot more liquid. Or you can put it in a bond. You actually can't anymore, but you could put it in a bond or something else, and it's, it's a lot safer. But you didn't make 6%. This is why you want to take advice from people that understand real estate. You didn't make 6%. You made 30%, right?
Correct.
So, and this is also why I don't buy everything fully with cash. Because your rate of return is significantly higher if you use leverage. But you want to be safe about it. Don't leverage 100%, obviously. You want to be safe about it, but that's the magic of leverage.
That was such a good point. That it was such an excellent point. And as long as you ladies get the rate of return formula, and trust me, by the time we get through the other 4 ways, it's going to be etched in your mind, just like it was etched into my mind when I studied this. And you will then recognize how powerful a vehicle real estate is, right? Because you put a little bit of your money into a hard asset, 12 months later, it increases in value. What did you do? You didn't do anything. You just held on to it, right? And it increased in value, and it pays you that way. So, think about it. If the market increased 10%, right? And your $100,000 property went to 110,000. Now you've got 10,000 in profit divided by 20,000. I don't even know what I've got to do. I've never done the calculation.
So that's
right?
50%.
So let's do it like that.
It's 50%.
Yeah, there you go. It's a 50% rate of return on your money in 12 months. That's incredible. What if you had 10 properties and this was happening to you? Think big, right? This is how you become a millionaire or a multimillionaire, is through real estate. So we'll summarize appreciation one more time, and then we're going to jump into the second one, which is cash flow, right? So appreciation pays you if you made $6,000 in a year divided by your $20,000, you made a 30% rate of return on your money. Killer, right? Where is anyone getting? I know you can't answer me, but literally ask yourself: is anyone anywhere on this call earning 30% return on their money? If you are, I would love to chat with you, because then I want to get into what you know. I want my money working as hard for me too.
Well, in a safe asset. Now, this is the other thing, is we're holding a real asset that is not going to disappear because the market changes. It's still land. It's still property. It will still be there. Even if we have a bad year, it's resilient. It will come back. Right. So we're not talking about making 30% because you're trading options, in the same month. You're doing short-term options. We're not doing derivatives. We're not doing whatever, flipping or whatever. Right. We're doing something that's very, very safe and secure. It's a hard asset that has proven over time to appreciate. Right.
True. All good points. Awesome. So ladies, that is way number 1. It's appreciation, right? All right. Now, number 2 is cash flow. So a lot of us investors, we're always very focused on the dollars that are coming back to us every single month based off of what we invested into that rental property. And I'm going to go just really low ball here, because I've been doing this for 10 years. And I know that there are some properties that will cash flow $400 a month. Some will cash flow $300. Some will cash flow $250. I'm going to go really low on the cash flow and say that after all the expenses are paid, the monthly cash flow out of a rental property is $150, right? So we're going to take $150 and we're going to multiply that by 12 months. And that comes up to $1,800. Ladies, is that profit?
Yes.
The answer is yes. Right? So
that's after all expenses. So after maintenance, after management company, everything.
After everything, $150, right? So at the end of 12 months, you now have $1,800 in cash. That is profit to you. Is it not? Say yes.
Yes.
Good. All right. So now what do? You plug it into the formula. Rate of return equals profit, which is $1,800 divided by your equity, what you have in on the deal, $20,000. That's your down payment. So when you take $1,800 and you divide it by 20,000, you get 9%.
Oh, okay.
And that's only at $150. What if I gave you $250 a month, right? That's something to think about. So let's go back, because I know repetition is what gets things in the mind. You earned 30% rate of return on appreciation in 12 months. Your cash flow produced $1,800 at the end of that 12 months. That produced a 9% rate of return. So 30% on appreciation, 9% on cash flow. That's a 39% rate of return on your money. And I still have 3 more to go. Are you interested in learning how it works?
Yes,
ladies. Yes. Okay. So the third way that real estate pays you is through the loan pay down. This is where leverage comes in. And I'm glad that Monica's on the call here with her mortgage background, because she might add more than I know, because I don't have the mortgage background. So she could probably contribute a lot more to this particular point. So in short, let's say, ladies, we buy a $100,000 house. We put 20% down, or $20,000, and then we have a mortgage note for $80,000. At the end of 12 months, so 12 months from the first date of the loan, we don't have an $80,000 balance anymore. We probably have I'll make it simple, a $79,000 balance, because your mortgage payment has 2 parts. It has your principal and your interest. The interest is the only expense. That's paying the banker for lending us the money. That's how he makes money or she makes money. Thank you for lending it to us. The principal payment, or the principal part of the mortgage payment, is like putting money into your own account. So at the end of 12 months, if your loan balance is goes from 80,000 to 79, that's $1,000 of what? Profit to you. Is it not?
it is.
It is. So what do? Plug it into the formula, right? Rate of return equals profit, $1,000 divided by your $20,000, right? Let's do the math on that one. That comes out to, my nails weren't so bad, I would put up the number 4, but I don't put up the number. 4%, right? So 30% from appreciation, 9% from cash flow, 4% for loan pay down. And guess what happens every year with your loan? Monique, I know you know the answer to this question.
Yes, absolutely. I was wondering if you were going to say it.
Yep. Are you paying down more each year? Are you getting more towards principal each year, or less?
More.
More.
So the way that works, ladies, is that when you get a loan, and this is why it's so amazing to get a 30-year loan right now, because in the very first year, the bank is going to take as much money as they can in interest and have less in the pay down. That's why it's called amortized. It's not a thing that we can just calculate in our heads. We need an amortization calculator because they amortize it. So the first year, they're going to have a higher chunk that goes into interest and a lower chunk that goes into principal. And then as the years go on, that flips. It happens very slowly. It's kind of like an hourglass, not an hourglass, but there's a crossover. At some point, you're paying much more in principal than you are in interest. So if you can get a 30-year loan right now at, say, 3 3/4%, that you hold that in for a long time, and then you get to see that turnaround where you're paying down your principal much faster later on.
So that means your rate of return keeps getting better year over year over year. Mm-hmm. So just keep that in mind. Okay, so 30% on appreciation, 9% on cash flow, 4% on loan pay down. There's a lot of people that buy real estate for the tax advantages. One of them is called depreciation. So how do you calculate depreciation, and how does it relate to profitability to you? So what a lot of people don't understand is that the US tax code is not a penal code. It may feel like it if you're not contributing back to the US economy in a big way. Here's what I mean by that. If you are a risk taker, if you are a business builder, if you are somebody that is employing lots and lots of people, 500 or more, let's say, right? The US government gives you certain tax breaks because the US government cannot do all things for all people all the time. They need entrepreneurs, business owners, risk takers to help them meet the needs of their population. So if you grow agriculture locally, you get tax benefits. If you drill for domestic oil and gas, and that's a big risk, you know, that's a lot of money that you put to drill to try to find oil. If you find it, great. If you don't find it, then you can write that off as a loss on your tax schedule. If you house US citizens, I probably shouldn't say it that way. If you just house people,
People that live in your neighborhood.
If you house people and they pay you rent, then the US government is going to allow you to depreciate that asset every year for the next 27 and a half years, which means you get a tax break for the next 27 and a half years on that door and any other door that you own. Don't ask me where they came up with 27 and a half. I have no idea.
That seems so random.
It's so random. And just, it was someone like, we can't decide on 30 or 20, so let's just go 27 and a half and call it a day. They're like, okay, meeting adjourned. Right? Don't know why, but anyway, that's the rule. So how is depreciation? How does depreciation put more money in your pocket? Let's run through the formula, right? Let's take that same $100,000 property that we purchased with leverage, and let's say that you cannot depreciate land. Land does not lose its value. Now the structure has wear and tear. So yes, and there's costs that we as investors and landlords have to pay to maintain that property. So the US government says, hey, thanks for housing our people. You're gonna get to depreciate your asset for the next 27 and a half years, and here's how you calculate it. Take the $100,000 property, you gotta subtract out the cost of the land. Basically a good 10% is a good way to calculate that. So you take a $100,000 property, multiply it by 10%. Now you've got a structure valued at 90. So the land is valued at 10,000. The structure is 90,000. What do? You take the 90,000 and you divide it by 27.5 years. Okay. And if some of you have calculators, I'll go along with you. I'm going to do it right now with you. All right. So let me go here. So you take 90,000 divided by 27.5, and that comes up to $3,272. Okay. Is that your deduction though? No. Here's why. The difference between me, you, and Monica, and everyone else on this call listening is that we all fall into different tax brackets. So you have to take that value and then multiply it by your tax bracket. So let's just say, I'm just going to say 35%, right? Because you guys all make killer money and you're amazing, fabulous women. Or higher, right? So $3,272, I'm going to multiply that by tax bracket of 35%.
So that's 0.35.
Yep. And that comes up to $1,145. That means the US government says, hey, Monica, thank you so much for housing our citizens. Appreciate you giving them housing. So you can depreciate your asset every year. And this year you get to depreciate $1,145 in that asset, which means you get to keep that money. We don't want it. You keep it. Is that profit to you?
Yes.
Because you don't have to pay the government. Exactly, right? So that's the fourth way that real estate pays you, is you can depreciate the asset and you get to keep that money. So what do we do when we have profit? we roll it into our rate of return formula, right? Rate of return equals profit. So $1,145 divided by, I wish you all guys could say what the number is that I know you're learning, but I'm like, you divide it by what? Divide it by your equity, which is what?
$20,000.
So you divide that by 20,000 and that comes up to 5.7%. Can I round it up to 6? Will you guys be okay with that if I said 6%?
Yep.
Okay, awesome. So let's just stop here for one quick second and let's just add up the numbers, right? So we earned 30% on our money from appreciation. We earned 9% money from cash flow. We earned 4% from the loan pay down. And now we just earned 6% from depreciation. That gives me a 49% rate of return on your investment.
Every year.
Year.
And it's going to go up from there.
The last way that real estate pays you is not easy for me to show in a calculation. It's easier for me to just explain it as a bigger picture. So have you guys heard of the term buying real estate as a good hedge against inflation?
Yes.
What the heck does that mean? Does anyone know what that means, you know? And then, but how does it mean in a calculation? And a good friend of mine who's a lender has a calculator that shows this. It's a proprietary. He's still working on it. It's not quite complete, but he showed me the prototype. And I said to him, I said, Aaron, you have got to give that to me. I need to, this is exactly what I need to show to, in mathematical terms, it'll explain how real estate is a good hedge against inflation. But in short, think of it this way. When we borrow money, we're locked into a certain payment for the next 30 years. 10 years from now, 5 years from now, next year, most of us, everything goes up. The cost of living goes up. Your salary goes up, hopefully, if your boss likes you and you get your 1 or 2% raise. That's what mine were, you know, when I was working in the corporate world. So you're earning more money as time goes by. The banker, though, they're not asking us to pay back the loan in inflation-adjusted dollars. They're asking us to pay the loan back in nominal dollars. So as you earn more, you know, they're not asking you to pay the loan, the value of the loan doesn't go up, you know, so you're earning more and you're paying back the loan in nominal dollars that were back here kind of locked in time. It was a long time ago. So that comes out to around 3% is how they figured it out. I didn't do the calculation, someone else did. I'm just trusting one hold.
And that will go up over time too, right?
Yeah.
Because as inflation raises and raises and raises and raises, and you're locked into a rate from many years back, right? Then that percentage of return for you is going to go up.
Correct. So if you were to tack on that last 3% with your hedge against inflation, I am now at a 52% rate of return on your money 12 months later after you purchased the asset. And now, when you can earn anything above 7, and this is just my opinion, any rate of return that I can get above 7% is stellar for me, because I know I'm beating, if inflation's at 6%, I'm earning anything above that, then I'm creating wealth. Any investment that earns below that, in my opinion, that 6%, you're just losing value. You're not earning. You're trying to just keep up, and that's what people talk about, the rat race. You know, I feel like I'm in the rat race. It's like, yeah, because, you know, as you get married, have kids, buy bigger homes, buy X, Y, and Z things, you've got more money going out. So you're locked to a job to be able to pay for all these things, and you're stuck. right? Because you're not having streams of income coming in from other places. You're just relying on that one income to pay for all of those things. And real estate, when you add, I mean, this was just one property. What if you took this 52% rate of return on one property and you multiplied it by 10 properties? And you don't have to buy all 10 today. You know, I talk with investors, it's building a portfolio slowly over time. And some of you, if you're in Monica's neighborhood, your property values, you probably have a lot of equity in your homes. And that's exactly what most of my California investors do, is they will take lines of credit on their primary residence, because let's say you've got $1 million sitting in equity, and that's very reasonable for where Monica lives. You've got $1 million in equity in your property, and that $1 million is just sitting comfortably in your house. It's not doing anything. Is it earning you any money? It's not. It's inert. It's sitting there. It makes you feel good, but it's earning you zero. So if it's earning you zero, it's like taking $1 million and putting it in a savings account earning 1%. Okay, if inflation's at 6% and your money's earning 1% in the CD through the bank, are you creating wealth with that?
Nope.
Million? No, right? Got to get it earning. And so the biggest hurdle for, I think, a lot of people is they go, I don't want to touch that. It makes me feel better there. I want my house paid off. Whereas I don't want my house paid off ever. I want to be able to deduct the interest, and I want to have I've got a line of credit on my house that I have access to anytime that I want to go buy investment properties or anything that's going to produce cash flow for a monthly basis, because I'm looking for more streams of income so that you can escape the rat race. And this is the way that I have learned, and Monica and I are the same mindset. This is how we have learned what real estate does for us and our families. And that's why we're so passionate about teaching you the 5 ways that real estate pays you. Because it's, 30% appreciation, 9% cash flow, 4% loan pay down, 6% depreciation, 3% on the hedge against inflation. That's not made up. That is just real math. Math is money and money is fun. Learn the math, learn to make the money. And real estate is a phenomenal wealth builder. And through learning the rate of return formula and plugging those little numbers in as you go, then you recognize that you're accelerating your wealth faster than the average 6 or 8% that the stock market yields, without all of the whipsawing and the heart palpitations that you get. Because as you get older, like I am, you get older. I don't like all of those. I'm an aggressive investor. I don't like all the whipsaws, because I could be losing 30% of my money in an instant. And it's like, what if I had 10 rental properties and they're all appreciating, 6% a year? That calculates to a 30% rate of return each year. That is a much faster, better, secure wealth building tool than something I don't have any control over in the stock market. So that's where, when you understand the math, ladies, and this is what I really wanted to, I'm hoping that Monica and I were able to accomplish that goal on this call, is that write that formula down. Rate of return equals profit divided by equity. And no, we have a 1-pager. We could probably attach it to this and as a nice little summary to send it out to you guys so that you have it. When you learn this, when you get these 5 ways, I didn't even talk about, you can write off the interest. That's not even something that I even talked about, right? There's another.
There are many other ways.
There are many other ways. These are just the 5 basic ways. And once you get these 5 basic ways, there is no doubt in my mind, you will then see the value of investing your money in real estate.
Yeah. And so what I will say is, If this sounds good to you, you need to have a deeper conversation with Maureen so she can run you through the numbers for your scenario. What we are going to do is in extra, we're going to actually build a portfolio. So we're going to start with, we've got this much money. I want to build a portfolio and here's my goal. So you guys, we're going to do like a pretend goal for me and we're going to do that. So she's going to actually show me how to build a portfolio. So stay tuned for extra for that. For your conversation, your personal conversation, call Maureen or email Maureen. Maureen, what is the email address they can reach you at?
I'm all about double consonants. It's my first initial last name. So MMCCANN. All those double consonants. McCann@SpartanInvest.com. I would love to chat with you. One of the things that I love doing is just finding out what it is investors want. And Monique, the conversations that I've had over the last 10 years, it comes down to people just want to take care of their families. They just want to live a financially worry-free life. They want to either supplement retirement, retire earlier. They want to pay for college for kids. I have some investors that have disabled children who, once they become adults, are still going to need care, and the parents know that when they transition off this planet, they want to have enough resources available to their child or children that they're leaving behind that have special needs, so that they're well taken care of. And I have some that just invest for tax purposes, just to reduce their tax liability. But it really comes down to those things. It just comes down to really wanting to take care of their families, and they just want a steady stream of income. And this is one really beautiful way to make it happen. And I get to help them build that for whatever their purpose is. And it's really cool to get to understand what their goals are.
I love that. And ladies, if you do connect with Maureen, and I encourage you to do that, please let her know that you came from me, so that she knows kind of the conversation that you have been in on already. That's going to be very, very relevant. And of course, you can ask more questions and get more details and all of that stuff. But it helps her to kind of give her a little context on where what your knowledge base is. So yeah,
cool. Would love to hear from you.
Awesome. Okay. So Maureen, thank you for that. That was amazing. And I can't wait to build my portfolio, my multi-million-dollar portfolio. I can't wait. That's going to be fun. We're going to be doing that in Extra. So ladies, if you are not subscribed to Extra, go subscribe. It's Real Estate Investing for Women Extra.com. Again, Real Estate Investing for Women Extra.com. The first 7 days are free. So you're going to get Maureen's extra. There's about 50 other extras up there so you can totally binge, and then you can decide whether you want to subscribe for the future or not. But definitely go take a look. Real Estate Investing for Women Extra.com. And if you already are subscribed, stay tuned. We've got more yummy, juicy stuff for you. Yay! And if you're leaving us now, I so appreciate that you joined us for this portion of the show. Thank you. And I look forward to seeing you next time. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart deeply desires. I'll see you soon. Bye. I hope you enjoyed today's show. If you'd like to download my favorite investing strategy, just go to blissfulinvestor.com. See you next time.